guys, Ashley Cheeks here with Pitch Investors Live to educate you on how to pitch perfectly to investors. Today is part 2 in the 4-part pitching series that talks about the documents that make up the fundamentals for your investor. We are going to talk today specifically about the financial forecasts that you need to have ready to go for your investor discussion. Your forecasts or your projections are simply explaining what it could look like in a couple of years for your business once it's operational. You need to understand that financial projections are something you have to have ready to go no matter what your business type. Some entrepreneurs fall into this trap where they believe they don't need projections for one reason or another, and I can tell you right now that is never going to be the reality. Building financial projections can be one of the hardest things for entrepreneurs to do. It's something that you don't typically have to do every day, and if you don't have a huge background in doing financials or accounting, it can feel a little bit overwhelming. The good news is it doesn't have to be that complicated, and typically entrepreneurs overcomplicate it trying to make it correct. So whether you already have your business plan forecasts developed, or you're working on them right now, or you've been in business for a while and you've been putting off developing your forecasts, today we're going to talk about 5 tips that should help you move forward confidently in developing great projections. First tip that I have to share with you about your financials is to make sure that you're rooting all of your information in concrete numbers and not in arbitrary data. You want to have information that is rooted in current reality for your future forecasts. This goes to everything from costing to your revenue projections. So on the cost side of things, you want to make sure that everything, including your salaries and including the cost for website development and everything in between, is based on a quote from a professional or is based on market averages that you find online. You want to make sure that the cost structure that you're putting in your business plan makes sense and is rooted pretty closely in actual estimates. Anything that is a guess or that's a deviation from an estimate is okay to include as long as you have an explanation for it. Anything that is a bit off track or off point from the industry average should just be noted. So if you're taking a salary, say, as a data point, and you want to give that person more than the average salary point, then just say, hey, this is 25% above industry average so that we attract the best talent and the most awesome people on our team. It's okay to go beyond the industry average. Just make sure you explain that somewhere in your financials. You also want to make sure that you get away from the idea that having something that is big enough would cover whatever you need. In your marketing section especially, this is where a lot of entrepreneurs go wrong. They'll pull an arbitrary number and they'll plug that as their marketing dollars, and they don't really know if that's enough. So if you're inexperienced in ad spend or you're not quite sure what your marketing strategy is looking like, don't just put in a plug and play number. Go do your research and go do your homework and find out how much money you really need to have at minimum to make your marketing goals a reality. For your revenues, make sure you root that in data as well. If you're not quite sure what your benchmarks look like in the industry, you need to research that. And if you have a disruptor business that maybe doesn't have a direct competitor yet, or that doesn't have another player in the space to baseline off of, simply talk about your revenues in terms of attainable sales. Make sure that you mention that you have a clear strategy for getting to a specific number of sales per month and per year, and that backing into those sales means X amount of dollars in annual revenue. If you know for sure that your marketing efforts will likely yield a minimum amount of sales, then let that explanation guide the rest of your revenue discussion. So you don't want to go from $0 to $1 million to $20 million in the first 3 years on your projections, unless you have a clear explanation as to why and how those numbers make sense. As long as you can explain it, it is okay to include, but you have to have a clear explanation to those numbers. The second tip to consider when developing your financial projections for investors is to make sure you're actually modeling out the offer that you're making to them. If you believe that you have a certain valuation on your business, your financials have to prove that, and your equity offer has to make sense within the context of your financials. So if you're pulling numbers out of the air like $100,000 valuation or a $10 million valuation, you need to make sure that your revenues support that by the end of its forecasted projection. If you're using a revenue-based valuation method, then your revenues have to actually walk to the valuation that you're mentioning to investors. If you're making an equity offer to an investor, but you don't actually model the equity distribution in the balance sheet, or you don't actually model out the shareholder distributions and the cash flow, then you can show the investor that you've not really thought this through enough to model it to even know if the business is healthy enough to sustain that level of distribution, or if there's enough equity to give away to the investor to begin with, or if the valuation that you've chosen even makes sense based on the revenue projections and the assets in the business. You need to make sure that your projections actually mirror, support, and reflect the health of the offer that you're making to the investor to begin with. If you say that your business is worth $1 million, but you never seem to get to $1 million in value in your financials, then it's not going to jive with the investor. It's going to be disjointed, and it's going to look like you really don't know your numbers, which, as you know, is a fatal mistake that you can make with any investor pitch. So make sure that you are actually modeling out the equity offer that you're making, the distributions that you're doing if you're offering distributions on revenue, and make sure that your investor understands clearly that these financial forecasts very directly mirror and even feed the offer that you're willing to make to them. This also makes the negotiation easier for you. Instead of saying that you're willing to offer 50% equity in your business and you don't really know if that is enough or not enough, or if you would go higher or if you're not sure, your numbers will tell you how much equity is right or wrong for your business based on the overall value of your business itself. Make sure you use your financials to guide those discussions and try not to go based off of gut feeling alone when it comes to actually determining how much equity you are willing to give or how much revenue share you're willing to offer your investor. When you model out your projections for investors, this is the opportunity to see how your offer will actually play out in reality. You can model forward what it looks like to do a revenue sharing deal, or to do something that has equity distributions that are structured throughout the year, or to have an interest-based loan with an investor as opposed to an equity deal. This way your investor can see that you've actually thought this through to the end, and you've actually modeled forward and can say with confidence that this deal would bring good cash value to the investor and would be a good, healthy option for your business to get the funds that it needs up front and sustain the repayment later on. It's hard to be able to assume what the right equity offer is to your investor unless you've actually modeled it out. So this is your opportunity to make sure that it's vetted and concrete, and make sure that you're actually making an opportunity offer to an investor that makes sense for you and to the investor. The third thing to consider when it comes to making perfect investor-ready forecasts is to not model too far. A lot of entrepreneurs tend to use templates out there that are pretty canned, and for some reason, a lot of those templates go out for 10 years. Now, every single time you create forecasts, whether it is a year out, 3 years out, 5, or especially 10, they're going to be wrong. Your financial forecasts are a guess, and unless you're a fortune teller, they're never going to be a perfect guess. However, the further out you go with your projections, the more likely it is that you're going to be way off base from reality for your business. Modeling forward is always difficult, but the further you go, the more difficult it gets because there's always going to be other variables that you can't predict. So keep it to 3 years. Your financial projections really don't need to go beyond that unless you're trying to model a certain repayment scenario. At 5 years, that's about where the absolute buffer is. Some businesses, it makes sense to go to that point, but that's usually the brick wall. If you're using a business plan template that tends to take you to that 10-year mark, you're probably using the wrong template. Typically speaking, modeling out to a 10-year point only makes sense for very, very specific business types. Those businesses have a maximum potential and they're really modeling out to that max point. They're not modeling out for the sake of clarity long term. Think in the terms of having a nursing home with a fixed number of beds and the owner has no intention of expanding. In his case, maybe he gets to 100% capacity in year 10 and he models to that point. But most businesses do not have that maximum potential. Most of them have unlimited potential if they have the right strategy in place. So for your business, make sure that you're modeling out only about 3 to 5 years ahead. Anything past that point doesn't bring any value and really isn't of interest to the investor because the investor knows that these are way off base because who knows what's going to happen in a decade from now. When you have your financial projections modeled out by a few years at a time, you're really just showing the investor what your targets look like. What does it look like to have a good, healthy operation in a few years? That's what your investor wants to see. So as you model this out, try to keep this as reasonably short term as you can and try to hit that 3 to 5 year benchmark when it comes to duration for your financial projections. The fourth tip that I have for you is related to creating a contingency bucket for your forecasts. In general, because your forecasts are always wrong, you want to make sure that you're planning for that worst case scenario. Generally speaking, people underestimate their costs and they underestimate the things that are going to bring expenses in the future. Human nature, and it's normal. The way that you buffer this is by adding a contingency bucket or adding contingency to every cost item in your business plan. My personal preference is to have a single line item that says this is a 20% cost contingency or a 10% contingency that covers the unexpected, the unknowns, and the costs that we're not planning for that we're sure are going to come up. The same way that you can't forecast properly in a 10-year span, you really can't talk about what is going to happen in the next couple of years with 100% accuracy, because chances are things will go wrong or will be more expensive than you thought, and that's okay. It should be expected and planned for. Having a contingency line item in your financial forecast is something that investors would expect to see from a more seasoned entrepreneur. So if you're a first timer or you're a startup and you have that in your budget, it's going to reflect very well upon you by that investor. When you have a single line item for contingency, you're actually increasing the level of rapport with your investor by being transparent about the fact that you've got a little bit of a wiggle room area in your budget for the unknown. Your investor knows first and foremost that you're going to have things that surprise you as you get started with your business. They're going to appreciate the transparency that some of your asking amount does include cushion for the unknown. As long as you have a transparent line item, say it's 10% or 20% for contingency unexpected items, it can really help the investor see that you're really planning for the worst and that you're ready for it. And it's going to show them that you're being really open and honest about what you need and why you need it. So you don't have to hide extra money in the asking amount or allocate things to buckets that don't exist. Simply call it a contingency line item and let that investor know that you're planning for things that may be on the horizon that you're today not aware of, but you're sure are coming up. Now, the fifth tip to consider when it comes to creating great forecasts is to make sure you're showing the investor a simplified view. Again, this is an area that many novice entrepreneurs tend to overlook, and they think that more is more. When you're doing your forecast, you want to make sure that everything is rolled up as much as it can be without omitting key facts. So instead of itemizing out to the point of extreme detail, you actually want to abbreviate everything as much as you can. So you're creating pro forma forecasts that are a little bit smaller in size, but that still show you the picture of the financial health of the company. So for instance, instead of showing month by month cash flows, pro formas might have an entire year rolled into one column, and column 2 for year 2 and column 3 for year 3. That's just the rolled up version of your financials. And when you expand it, you can see that it's based on month by month forecasts. This way your investor can take a glance at your forecast and they can understand what's going on. When you roll your pro forma categories together in ways that are grouped, so your personnel costs, your marketing costs, your operations costs, maybe even a lease or a mortgage payment, this way your investor is able to see clearly kind of the general bucketized categories for your business and the costs that are associated with all of these activities. Now they can have an editable version of the spreadsheet for themselves later on, or if you're using a software, they can go to that software and visit things natively. But either way, you want to make sure that your investor has access to that for more information if they want to see it. Some investors don't want to dig in the details and they genuinely want to stay high level enough to get a clear understanding and then take things to the next discussion. They don't necessarily want to dig through your tax structure. They may not care. They've kind of been there, done that, and they understand what it means to capture state and county taxes. Rolling your financials up in a way that is easy to understand and that has subcategory groupings for quick skimming is going to help your investor make a better evaluation. If you give them too many details at once in your financials, they're going to be overwhelmed with what to look for and what makes sense and what doesn't. So you want to keep things as high level as possible. Now in the end, they're likely to ask you for the editable full financials so that they can take it away and at their perusal, look at the finer details. But most investors have a high-level preference for a specific type of document, whether it's the income statement or the balance sheet or the cash flows. They tend to have that go-to document that they want to focus on, and they want to see it as purely as possible without way too much information in it. For these reasons, you need to make sure that you roll everything up as much as you can and keep it as high level as possible so that they can look at it, interpret it, and understand it in a way that's quick and easy so they can take away general cost ideas, general revenue direction, and have a formal conversation with you next about your pitch and the rest of the things that you have planned for your business. Thank you so much for your time. If you have any questions or need support developing your financial projections, please reach out to me. I'd be glad to help you with some templates, tips, and advice. And make sure you tune into the next video, which talks about how to create the perfect investor pitch. Until next time, stay positive, entrepreneurs.